Thank you very much for the invitation to speak to you today. It's a pleasure. So I'm here to talk about this new ADB report called Meeting Asia's Infrastructure Needs. We released the report 1 month ago, and it's available for free on the ADB website. And Matsuo-san, I think, is planning to translate the highlights or the executive summary to Japanese, so that will be available as well. The last time the ADB published a similar study was in 2009. That report was called Seamless Asia, and the estimates there were that developing Asia needed about $8 trillion in infrastructure investment from 2010 to 2020. That's roughly about $750 billion a year. This new report provides an update of the region's infrastructure investment needs for a longer period, and a period looking in the future, from 2016 to 2030, 15 years. And so one question is, why do an update now? Well, one obvious reason is that 8 years is a long time. The old report focused on the period from 2010 to 2020, and we're now in 2017, so that old report really is talking much more about the past than about the future. In addition to that, there are also 3 big changes that have happened in the last 8 years. So it's been a tumultuous or a fast-changing 8 years. The first big change was when the 2009 report was written. The world was still in the middle of the global financial crisis, and there was a lot of uncertainty about where the world was headed. Now, 8 years later, the picture is clearer. As Sawada-san's presentation showed, developing Asia is still growing robustly and is expected to continue to do so in the coming years. And so Asia's infrastructure will need to keep pace with that expansion. And because of this, it's useful for policymakers, for investors, and for the general public to know exactly how much that infrastructure investment is needed. A second reason for doing this is now we have a much better understanding of and appreciation of climate change and its impact compared to 8 years ago. One reflection of this, for example, is the 2015 Paris Agreement, which sets a climate goal of keeping the global mean temperature increase to no more than 2 degrees centigrade above pre-industrial levels. So infrastructure will be influenced by climate change. There's a need to climate-proof infrastructure, or keep it resilient to things like sea level rise or more extreme weather events. Also, infrastructure has a key role to play in ensuring that we can meet that global goal, in that, for example, a lot of carbon emissions come from energy production. So our updates incorporate the impact of climate adaptation and mitigation on investment needs. The third big change is that the infrastructure landscape in developing Asia has evolved. Private participation has increased, and there are also new players such as the Asian Infrastructure Investment Bank and the New Development Bank. So the report looks at the roles that various players, both from the public sector to the private sector to multilateral agencies, can play in ensuring that we can meet these infrastructure investment needs. So we set ourselves 3 objectives when we were writing this report. We begin with an examination of the current state of infrastructure in developing Asia. So how much infrastructure countries currently have and how much they're investing. The report focuses on 4 major infrastructure sectors. These are power, transportation, telecommunications, and water and sanitation. Second thing we do is basically to update those ADB estimates of infrastructure investment needs, as I said, from 2016 to 2030. One important thing we do now is that we actually cover all of developing Asia. The previous report and most other studies you'll see on this cover only a subset of Asian countries, but we cover all 45 of the ADB's developing member countries. And the third thing we do in the report is to think about how those needs can be met, and we focus on 2 aspects. One is how it will be financed, both by the public and private sectors, and second, what actions are needed to address institutional and capacity issues relating to planning, designing, and implementing infrastructure projects. So let me summarize the key messages here. First, developing Asia needs to invest about $26 trillion in 2015 prices. That's about $1.7 trillion a year between 2016 and 2030 to sustain growth and respond to climate change. If you take out climate change mitigation and adaptation costs, the needs are $22.5 trillion over that period, or $1.5 trillion a year. These annual estimates are more than double the ADB's previous estimates in 2009. An important point is that infrastructure gaps, which are defined as the difference between estimated needs and current investments, vary widely across the region. So some countries are investing close to what's needed, others are much further behind. So China, for example, for the People's Republic of China, the gap is relatively small, but if you take out PRC, the gap is about 5% of GDP. And filling the gaps requires both public and private sectors to increase infrastructure financing, and reforms are essential to doing this, and we'll talk about that later on. So let me begin by talking about the current state of infrastructure in developing Asia, and how much they have and how much they're investing. So let me begin with a well-known fact, and nobody needs convincing of this, I think. Infrastructure plays a critical role in development. It's a key factor of production, it enables trade and investment, and it's a key driver of productivity growth, as Sawada-san has just shown. This slide basically just shows that there's a strong relationship between the level of development as measured by per capita GDP here, and provision of infrastructure, where this is measured as this is a composite of different types of infrastructure, including, again, transport, telecoms, and water and sanitation, and power. And so the chart shows an association, but it doesn't establish causation. It doesn't tell us that it's infrastructure that causes development. So one of the things the report does, I won't go into it, is it surveys the microeconomic studies that document the positive impact that infrastructure has on output, on poverty, on employment and wages, and other outcomes. So the region's infrastructure expanded significantly in recent years. So the numbers in green here show annual growth in, this is just one example, electricity generation capacity, but the report also looks at, again, transport, water and sanitation, and telecommunications. And so what you see here is that between 2000 and 2012, annual growth in electricity generation capacity per capita was about 7.4% in developing Asia. So pretty rapid, especially when you compare it to growth in the OECD of 1.9% and other developing countries of 1.1%. Despite that, you can look at the blue bars, which tell you that we're still far behind, developing Asia is still far behind OECD levels. Electricity generation capacity per person is about 1/5 what it is in the OECD. And as you can see here, there's large variation. So 9 out of 23 countries actually have electricity generation capacity, which is less than 10% of that in the OECD. And it's not just a matter of quantity. The right-hand side also shows the quality of electricity production, and as measured by losses in transmission and distribution. And you can see that in countries like Nepal, Cambodia, and Myanmar, close to 30% of electricity is lost during transmission and distribution. For other countries in the region, the losses are much lower. But so the bottom line is that there are still big needs in terms of both quantity and quality of infrastructure, and I'm just using electricity here as one example. One key determinant of this quality and quantity of infrastructure is how much countries are investing in infrastructure. And it was actually a surprise to us to find out how bad the data on infrastructure investment is. One reason for this is that there are multiple actors in the sector. So infrastructure is provided by governments, both the national and subnational governments. It's provided by state-owned enterprises. It's provided by the private sector. And there are also various data sources one can use, ranging from budget documents, which help you get to the public sector, and you have investment data from the national accounts, and you also have data on private investment. None of these measures is perfect. Each has its advantages and disadvantages. And the report actually talks about how best to measure this going forward. But for now, basically the measure we use that we show here is based on budget data to capture the public sector, and a data set called the Private Participation in Infrastructure Database from the World Bank, which covers investment by the private sector. And so the numbers here we show are for those 4 sectors I mentioned from for the period 2010 to 2014. And what you can see is a wide range of infrastructure investment as a percent of GDP, ranging from close to 2% for Bangladesh to up close to 7% for the People's Republic of China. You can see that many countries, 9 at least in this chart, invest less than 3% of GDP, which is a low number. As you'll see later, investment needs are substantial. You can also see from this chart the extent of private sector participation, and it varies a lot as well. The share of private infrastructure investment is around 80% in the Maldives here, this orange bar. It's about 50% in the Philippines and Pakistan, and about 40% in India. And on the other hand, you have countries like the People's Republic of China and Mongolia and Bhutan, where the amount of private infrastructure investment is negligible as a share of the total. If you look across sectors instead of across countries, you'll see that there's a large variation across sectors as well. So some sectors are more attractive for private sector finance. Telecommunications, for example, has more than three-quarters of it being provided by the private sector. In the power sector, it's close to half. And you have much less private involvement in infrastructure, in transport, and in water and sanitation. And there are reasons for that. I mean, one is the feasibility of cost recovery is higher in some sectors. So the ability to charge, to impose user charges in what economists call excludability, that you can actually prevent people who don't pay from availing of the service. But another factor is also the desirability of cost recovery. So even in cases where you could charge, you may not want to, either because there are positive externalities or for reasons of equity. Okay, so turning to that second part of the chapter of the report, assessing the region's infrastructure investment needs. Again, we do this for all 45 ADB developing member countries, starting from 2016 to 2030. And our methodology basically follows a similar approach to the 2009 study. We start out with baseline estimates, which are derived using the relationship between different types of infrastructure, things like road kilometers or kilowatts of power generation capacity per capita, and on the one hand, so infrastructure and how it's historically been related to economic and demographic factors, things like per capita GDP, population density, urbanization rates, and the share of industry in the economy. As mentioned earlier, we go beyond this. The contribution of this report is to then adjust these estimates for the effects of climate change. So on top of these baseline estimates, we add on the investments that are needed for climate mitigation. This is primarily shifting away from shifting to low carbon sources of energy. And the estimates there are based on a study that came out last year in the Asian Development Outlook update. We also add climate-proofing investment needs, things like elevating road embankments or moving water intake upstream to avoid salinity. And those are based on ADB or ADB estimates or existing studies. So in the table here, I present both the baseline and the climate-adjusted numbers. So for developing Asia as a whole, all 45 developing member countries, total investment needs in 15 years is about 26 trillion if you adjust for climate change, which amounts to about 5.9% of GDP. If you look at the baseline estimates where you don't account for climate change, it's still substantial. So about 23 trillion, which amounts to about 5.1% of GDP. On an annual basis, the figures would be 1.7 trillion and 1.5 trillion. So climate change adds about roughly about 200 or 100. What is this? 240 billion a year to the needed investment. There's large variation across subregions, as you can see here. If you look at the absolute dollar amounts in this third column, the biggest needs are in East Asia. Obviously, that's where China is, about 16 trillion over the 15-year period, followed by South Asia at about 6 trillion, and then Southeast Asia. But if you look as a percent of GDP, which might be a more useful benchmark, it's actually the Pacific countries. So they're very small in dollar amounts, but they have the largest needs in terms of, as a share of GDP at 9.1%. That's followed very closely by South Asia. Another way to look at these numbers is to look at investment needs across the 4 sectors. And here we focus on the investment needs where we include the effects of climate change. And by far, the sector that needs the most investment is the power sector, which needs about 14.7 trillion in investment. It accounts for approximately half of the investment needs. Transportation comes next at about 8 trillion, which accounts for about a third. And telecommunications and water and sanitation are a smaller percent. This reflects in large part the fact that it's just more costly. Power and transportation, it doesn't reflect relative importance. It reflects that these are the more costly sectors in infrastructure. Let's look at the third issue, which is, and this is really in some ways the most interesting or the most challenging part. How exactly do we meet these infrastructure investment needs? For this part of the report, we restricted the analysis to just 25 countries for which we had data, because one of the questions we ask is how much can the private sector do, how much can the public sector do, and data limitations don't allow us to do it for all the countries, so we restrict our analysis to 25 countries, but these 25 countries still account for 96% of developing Asia's population and about 85% of its GDP. So we begin by asking, how big are the infrastructure investment gaps, again, defined as the difference between current investment and needed investment. So we look at current investment as of 2015 here. And as Sawada-san had already showed, countries are currently investing 881 billion, of which the PRC is actually accounting for the lion's share, about 690 billion. And the rest, the other 24 economies we study are accounting for about 200 billion. And if you compare that to annual needs, so this was the other number that Sawada-san showed in this chart, it's 1.3 trillion for these 4 countries. Let me also say that apart from restricting it to a smaller sample, here we focus on, you might say the near to medium term, the next 5 years, because 2030 is so far off. And if one wants to talk about what we need to do now, or this may be the more relevant comparator. So the needs are basically about 1.34 trillion, of which about 800 billion annually is in the PRC, and about 500 billion annually is in the rest of developing Asia. And so if you subtract this from that, you get the estimates for gaps. And so for the 25 countries altogether, I'll call it developing Asia, the gap is about 2.4% of GDP. Seems not too insurmountable. If you break that down, though, into China and the rest of developing Asia, China is not far. It's only short by about 1.2% of GDP. If you take out China and you look at the second row here, the rest of developing Asia needs to invest an additional 5% of GDP. And again, if you remember the previous numbers we showed where many of these countries are investing about 3% of GDP, that does present a big challenge. And so the question is, how do we bridge these gaps? So because China is not so far off, and they're also better at, when they need to, they're able to raise their infrastructure investment spending much more easily than in other countries. For the subsequent analysis, we're going to focus on these numbers here, this 500 billion a year that's needed, and this 300, and the current investment and this gap over here. So here's the 503 billion that's needed. And the question is, and here's current investment, of which public investment is about 132 billion a year. Private investment is about half that, at 62 billion. And so the difference between this and that is the gap. And so the question is, how do we fill that gap? How is it even possible for developing Asia to meet these infrastructure investment needs? The way we approach it is to first look at how much the public sector can spend on infrastructure in each country. The way we do this is we use a concept called fiscal space. It's how much additional spending governments have for priority spending without endangering the public finances. And there are several avenues you can look at there. One is the potential for raising revenues primarily via tax reform. Another is the scope for reorienting spending, so to shift other types of spending toward infrastructure. And a third is, given the state of your public finances, the level of debt and deficits, how much more can you borrow without running into public debt problems? And what we found in the study is that there's many countries in developing Asia actually have substantial scope for raising infrastructure investment via those three measures. And if one assumes that they use half of that for infrastructure investment, because infrastructure is not the only thing they need to spend on, there are many other priorities such as social spending, they can raise about, the public sector can probably increase their spending from the current 132 billion a year to about 121, they can add an additional 120 billion a year. We're not saying this is easy. It still requires things like tax reform or, let's say, cutting energy subsidies. But the potential is there. Again, and these measures were identified, for example, using IMF country reports where they looked at specific measures that could raise policy. So we're not talking about abstract things that governments can do. These are tax reforms that have actually been identified, for example. So if the public sector can generate this much additional infrastructure financing, the remainder will have to be filled by the private sector. And so effectively what the private sector would have to do is raise its infrastructure investment from the current levels of about 60 billion a year to, well, the sum of those two, which is about 250 billion a year. So it's a fourfold increase, which again seems like a lot, and we'll talk about how that might be done in the next slides. So the numbers again are pretty eye-popping, but we believe the gap can actually be closed if the right policies are pursued. So if you think about the public sector first, which still accounts for the lion's share, more than 90% of infrastructure investment in the region is done by the public sector. What can they do? So we talked about the three things I mentioned before. On the revenue side, tax revenues in the region are still relatively low, and more than 4/5 of the countries actually have scope for sustainably increasing revenues via tax reforms, but also even things like just improvements in tax administration. On the spending side, there's also scope for reorientation, and our estimates are that half of the countries in the region can do this. Again, a lot of it is, let's say, cutting things like fuel subsidies or other poorly targeted subsidies. Reform of state-owned enterprises is also important because in many countries, a lot of government revenues go to subsidize loss-making enterprises. In a few countries in the region, they also have public sector wage bills that are relatively high and could be restrained, and that could generate additional space for infrastructure spending. The fourth item here, we wrote non-tax revenues, but one important part of non-tax revenues is infrastructure-related revenues. And here there are three types of revenue streams that one can think of. One is the user fees I mentioned earlier. In many countries in the region, user fees are set way below cost recovery. So just setting them at the right levels will help generate additional revenues that governments can use. A second important revenue stream is what's called land value capture. And this is something that Japan has used, China has used a lot, Korea has used it as well. And the term simply refers to governments being able to capture some of the increase in land value that occurs as a result of the infrastructure investment. So in China's case, they actually own the land and they either lease it out. In other countries, it's a matter of taxing the increased value of the land. A third form of infrastructure-related revenues are what's called the capital recycling. So once you've built infrastructure and it's now what's called the brownfield asset, you can sell that and use the proceeds to invest in new infrastructure. So that's on the public sector side. As we saw in the previous chart though, a big challenge is actually promoting more private sector participation. But the private sector won't invest in these countries unless conditions support it. Important elements in this regard are political and macroeconomic stability, for which in many countries you actually have it, much better than, let's say, 2 decades ago. As we saw from Sawada-san's presentation, growth is strong, inflation is low. Other important conditions that shape the investment climate are things like good governance, adequate investor protection, and sound market regulation. There's also scope for greater use of public-private partnerships. The Philippines is one country that's done this well, and other countries are also following suit by enacting PPP laws, streamlining procurement and bidding processes, and introducing or strengthening dispute resolution mechanisms. Deepening bond markets is a critical part of critical for attracting long-term investors as well. Banks have been an important part of financing infrastructure, but increased capital requirements, because of Basel III, for example, and also the inherent maturity mismatch. Banks have their deposits short-term, but these are mostly long-term investments. Suggests that bond financing really must play a bigger role. And things that can promote that are credit enhancement and just bond market development in general, which would require, for example, strengthening the bankruptcy code and credit rating agencies. Last point I want to make, which is this last bullet here, is that it's not just financing that's the issue. There's what we refer to as an ecosystem of the infrastructure planning, design, and implementation. A lot of this has to do just with coordination within government, with the national level and the subnational levels, but also coordination between the public and the private sectors. It also refers to the capacity to do high-quality planning and project design, to make sure that things get done on time and within budget. And again, this well-functioning ecosystem would help ensure that not only that public investments are more efficient, but also it would help attract private investment by creating a pipeline of what's referred to as bankable projects. So let me end with the role of multilateral development banks in infrastructure, in fulfilling these infrastructure needs. if you look at how much financing multilateral development banks like the ADB provide, it's a small share. It's 2.5% of total infrastructure investment. However, if you take out China and India, it's more than 10%. So it's not trivial as well. And what we will likely see over the coming years is that this will increase over time. As we mentioned, there are new players such as the AIIB and the New Development Bank, which are just getting started and are ramping up their infrastructure financing. The ADB as well is scaling up its financing from 17.5 billion last year to more than 20 billion by 2020. 70% of this goes to infrastructure. But it's not just finance. The role of MDBs is actually, again, given how small it is, the role of the MDBs is actually in supporting all those other things beyond finance. It's combining finance and knowledge. So, for example, the use of advanced technologies or helping strengthening government capacity in planning and implementing. Those are things that MDBs can do beyond simply providing finance. So let me just recap by summarizing the key messages again. Needs are large, about 26 trillion over the 2016 to 2030 period, or about 1.7 trillion a year. Climate change is a part of that. If you take climate change out, it's about 1.5 trillion a year. They're more than double the ADB, the old estimates we had. And again, there's wide variation across the region, with some countries closer to investing close to what they need, others which are far off. And that really, this point we want to drive is this is not something that the governments can do on their own. It requires involvement by both the public and private sectors, and reforms are key to getting both of those involved. And so let me end here. Thank you very much. Happy to take questions.
ありがとうございました。それではクエスチョン